Hello everyone, and welcome to my new web series on stock valuations. I am a value investor and I have been looking for companies to invest in which trade below their intrinsic value and also provide that margin of safety that Ben Graham and Warren Buffett have talked so extensively about in the past. To go through the valuation process, Jay June at Old School Value has been kind enough to allow me to use his spreadsheets as my platform to demonstrate my valuation techniques and my thoughts on given companies. You can go to oldschoolvalue.com and you can download the spreadsheets for free, and then there's a subscription service if you want to go and be able to pull in data. I found to be an invaluable tool to do analysis quickly instead of going through and filling out a bunch of spreadsheets by hand. It's all done for you, and you can actually get into the real art of finance and valuation on your own instead of spending your time just filling out data points. So with that in mind, I wanted to start with a company that I've been interested in for a while, and it's probably not a company that most investors look at. It's not a sexy company by any stretch of the imagination. It's Bed Bath & Beyond. I chose this company for a couple of reasons. One, I think it's a good investment. I'll be up front with this on the first one here, and I think there's potential here. I think it shows a good valuation technique. Plus, it's also it's a good company to understand. Everybody can understand the company and what they do. It's pretty straightforward. Everybody understands what a retailer is. So with that in mind, let's dig in. So what is Bed Bath & Beyond? Basically, they sell home items to the public through retail stores. They're a retail shop, and they sell bed linens and kitchen utensils and any type of household good out there that you use on a day-to-day basis. They sell it, and they've been pretty successful at selling it throughout the country for many years. So they're a brand name, they're a household name, and they have a fairly strong brand. So let's go into how they're performing on a financial basis. So if you go through the spreadsheet, this is the dashboard here, and this gives you very high level information on what's going on here, what's going on with the company, so you can get an idea up front. I try not to look at this first so that I don't bias myself, especially this chart here. This can kind of bias you whenever you see the intrinsic value being below the buy price. It can kind of skew your valuation. So let's ignore that for now. First thing I want to do is I want to go through the ratios and try to figure out what we're looking at here. As you can see, this spreadsheet, this tool, goes back 10 years, and it uses 10 years worth of data to create your analysis. I've tried to make this a little bit larger so that you can see it on a YouTube video. But you can shrink this down so you can get all 10 years in a nice format. You can also see a little chart here that shows you how it's trended over the last 10 years, just to give you a quick visual if you're more of a visual person and not a numbers person. So let's start with the PE ratio. It's trading at, right now, 12 times, 13 times trailing 12 months. In 2012 it was at 15 times, and as you can see over time, this metric has gone down. It's gone down from 31 all the way down to 15. What does that mean? It means either the company is growing into its share price from back then, or there have been declining earnings. So we'll have to investigate why is that price to earnings ratio shrinking. Is the market not expecting the growth that it was expecting before? Cash adjusted, this is just taking the cash out of the equation, and you can see it's trading times 13 times earnings and 12 times earnings on the trailing 12 months when you take out the cash portion of it, because cash is just sitting there. If you bought the whole company, you would get the cash as well, so we take that out of the equation. I think this is a better measure than just the normal PE ratio when you're judging the earnings. Let's moving on a little bit further down. We've got free cash flow at 13 times, price to cash flow at 12, price to free cash flow. This, I think, is probably the most important valuation ratio when you're looking at what the market thinks is this price to free cash flow ratio. You can see that it's trading at 15 times free cash flow, and that has also shrunk over time. It's kind of mirrored the PE ratio, where it's kind of slowly trended down a little bit, down to this normalized 15 times, 14 times earnings, depending on whether you use last year's or the trailing 12 months. Return on equity, how are we creating return to our shareholders? It's been pretty good. It's been over 20% in just about every year, except for those 2 years in 2009, 2010. This I can understand. I've kind of given a pass to a lot of companies on a slight dip in their metrics for this time period, given the financial crisis. However, I don't want a company that completely craters during that time. You want a company that will be somewhat stable, but I can give a little leeway over that time period because things happened that were extraordinary. Return on assets, that's pretty strong return on assets here. Return on invested capital, again, fairly strong in the 30s and the 20s. Cash return on invested capital, which is an important metric for seeing how is the company giving cash back to the shareholders. Shareholders can't spend other assets, they can only spend cash, and they only want cash, so we need to see how is the shareholder receiving cash return on its investment. And you can see here that they've done very well, 31% back in 2003, and they're around 31 to 23% now. Solvency. As a value investor and as my personal style, I look for boring companies. I look for companies that are very safe and do not have a lot of risk involved in their financials and how they're going to perform going forward. I would gladly trade a massive upside for a lot more security. I'm very conservative in that regard when I'm looking at companies. So this solvency area is very important to me. It may not be as important to some people who are growth oriented, but in my case, I value this greatly, and I value companies that perform very well in this solvency area, also in this liquidity area down here. So if you look at their quick ratio, what's their fire sale? If they need to pay off all their current debts today, what would they do? How would they perform? You can see it's been 1.5. It's at 1.55, and it's been in the ones except for 0809. For the most part, it's been pretty consistent. It's been pretty solid. They have assets to pay off all of their current liabilities. They have quick assets. Cash is the biggest one, obviously. Their current ratio, you can see also here, this is where we add inventory into the equation. If they had to burn off their inventory to pay off all those debts. As you can see, it's always very high. Typically 1 is the benchmark for a company. Do they have more current assets than they have current liabilities? But you can see here they have a 2.5, sometimes 3 in their current ratio. And they've held that pretty consistently. It's not a flash in the pan. So we can feel pretty confident in their current ratio also. Which means they have the assets to back up their short-term debt. They're not going anywhere in the near future, which is something that I like. I don't want to see a company that could be out of business tomorrow or is having those types of financial difficulties. Debt to equity, you can see debt very low compared to equity, total debt. But this is interesting here. Long-term debt to equity ratio and short-term debt to equity ratio. This company has no debt. All of this debt up here is consumed by their accounts payable, which is basically financing the inventory that they buy from their suppliers to sell to other people. So the company has no obligation, is not beholden to anybody else. It can finance its operations internally. It has decided it does not need to go out and borrow to continue operations. That's a very strong sign, a very positive sign. And you can see that it's been that way for the last 10 years at least. They have no issues with financing their operations from internal sources. I find that to be very positive and a very strong sign. This company is well run, and they have the management in place to generate returns to us as shareholders. Liquidity ratios, we can see here. This is interesting that their day sales outstanding is 0. they have absolutely no accounts receivable on the books. And I found this odd, and I thought it may have been an error in the spreadsheet. But when I went out and looked at their actual 10K, which I have up here, pull it up here. This is from 2011's 10K. You look at their balance sheet, and in their current assets, they have cash, short-term investments, inventory, and other current assets. They do not have accounts receivable on their books. That seemed odd to me. But then as you think more and more about what their business is and what they do, they're a retailer. So how are they getting paid? How is cash coming in the door? Well, it's mostly coming in the door through people paying cash up front, or people paying with their Visa, MasterCard, Discover card, and they're paying for things with very short-term turnaround. They're getting paid by Visa in 1 or 2 days. So this ratio here, this is okay that this says 0 here, because they are essentially a cash-based business. They're being paid very, very quickly. Inventory outstanding, I looked at this also. How long are they holding inventory? And this would be scary. This 135, 139 days worth of inventory would be scary if it wasn't so consistent. They've been in this range for the last 10 years, within 10 days of each other. It's a fairly stable company, fairly stable in their inventory, and they've managed their inventory very well. It's been very stable for them. And their days payable also has been pretty stable as well. They've actually gone from 60 down to 49. But it's within a range. It's consistent. There's no sharp spikes up where we would have any red flags. When we do look at the trailing 12 months, we do have to consider the nature of the business and what they do. The inventory spiked in this trailing 12 months. However, this is a balance sheet number, this trailing 12 months, and it's for the third quarter of the year. As we know, retailers buy significantly more inventory in the third quarter in preparation for the holiday shopping season. So seeing a spike in inventory during this time period is okay. We expect it. We do expect this to drop, though, in the coming quarter after the holidays are over and all that inventory has been burnt off by the holiday sales rush. So seeing this spike is okay. I'm going to go with this year-over-year number and say that it's been pretty consistent. I'm okay with this. And if you look at the previous year's best quarter in the previous year, it was a similar situation where inventory built up and then it was burned off of the holiday season. So this makes sense. If this was a non-cyclical company where sales were steady throughout the year, this could be a red flag, but given the nature of the retail business, I'm okay with this. So we go through capital structure. Again, as we said, no debt. This total debt here is comprised mostly of accounts payable. And then there's the Petrosky score and the Altman score if you're interested in those types of things. So let's go to the statements. I like to start with the balance sheet. As we said, they have some cash, pretty stable. Current assets in total have been consistently growing. They've been pretty growing in their current assets. How are they doing? So they have all these current assets. They have a lot of fixed assets. Interesting scenarios. They have no goodwill, so they have not been out growing through acquisition, or if they've been acquiring it below book value. So that's a positive sign that their growth has been organic and through their business model. As we said, their liabilities, you can see here that it's all in accounts payable, and there's some accrued liabilities in there as well. But no long-term debt, no short-term debt. That's a positive. They've been growing through internal growth, not borrowing to leverage the company. So let's go up to the income statement and see how are they doing. How's the business been doing? Let's look at the top line, revenue. Every single year, revenue has grown. growth, 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 growth. Every year revenue has grown.